Canadian inflation cooled to 1.8% in February, but with rising gasoline prices expected to take a toll, should we expect higher consumer prices going forward? Joining us now to discuss is Robert Both, Senior Macro Strategist with TD Securities. The thing about these, Robert, and we were discussing the fact that they are backward-looking, but for a moment we'll indulge ourselves. We'll go back. What's your reaction to the CPI report?
Well, I mean, this is the second month in a row that inflation has come in softer than expected. As you said, headline inflation back below that 2% target. We did see a very large one-time impact on this report because you had HST coming back on prices in February 2023 that brought food inflation down by nearly 2 percentage points on the month. So a lot of that moved from 2.3 to 1.8. Not something that's going to have a significant impact on the near-term outlook. We will see another one of those large moves in the next report for March as well. But you look past that, and you know we've seen a little more pressure come off for renters. Rents were down for their second consecutive month. You've seen a little more pressure come off for homeowners as well. Core goods inflation looks a little bit softer. So all of this is quite one-sided. Inflation is tracking below the Bank of Canada's previous forecast, at least over January and February, and that's where your comment about backward-looking data comes into play because, well, all data is backward-looking. When we're talking about February and inflation in particular, that definitely takes on some added importance given what energy prices have done over the month of March. So, you know, inflation is looking quite a bit softer than it did at the time of the last Bank of Canada forecast update. But you know, the world has changed, so that might not have the same direct impact on the next Bank of Canada decision as it would in a world where energy prices had not surged over the last 2 to 3 weeks.
Yeah, we think about the oil price going higher, and of course people are probably already noticing at the pumps. Natural gas prices globally have gone higher. We have a few different commodities starting to feel the pressure of all this. So we start thinking going forward, what does the Canadian inflation picture look like?
Well, going forward, it's going to be an energy price story. You know, it's a very volatile market right now. Things are changing, you know, day to day, in some cases hour to hour. You know, the inflation outlook is really going to be tied to the way that geopolitics evolve over the coming weeks and months. Now, near term, we are going to see we are seeing energy prices rise sharply. We're seeing that already reflected in prices at the pump over the next coming weeks and months. We should see more of that reflected in other energy products, heating fuels, natural gas. You know, you're going to see some downstream impacts on you know, things like air travel, food prices. So there is going to be some new pressures as a result of the conflict in Iran. But that does set up for an interesting challenge for the near-term Bank of Canada outlook, because if you just look through that, if you would, the rest of the economy is looking quite a bit softer. So, you know, in addition to inflation tracking below the last published forecast, we've also seen growth come in a little bit softer over the fourth quarter. You've seen some of that labor market resilience start to come off. Last Friday, we saw one of the largest month-over-month declines in Canadian employment since the pandemic.
How concerned should we be about that? I wanted to talk to you about that jobs number. It's still sort of fresh for some people, right?
I mean, I think, you know, you kind of saw just how jittery markets were on Friday because, you know, when that number came out, you did see the market pull back quite sharply on the amount of rate hikes they were expecting from the Bank of Canada. But that really only, it was a pretty fleeting impact. It seemed that, you know, as soon as markets pulled back, you know, there was enough market participants out there who were willing to fade that move. We ended the day still pricing about, you know, 1.5 rate hikes over the rest of the year, which, you know, we think is a little out of line with what's being priced in on the geopolitical front. We think the Bank of Canada is going to take a more cautious approach to recent energy movements, but that jobs report is concerning, given that the labor market has been this one source of resilience really over the last couple of quarters. We saw a remarkably strong job growth in Q4, even as other parts of the economy were showing a little more impact from trade uncertainty. So to see that come off does give the Bank of Canada a little more incentive to look through some of the near-term impacts of higher energy prices.
When we do hear from the Bank of Canada on Wednesday, how do they start addressing all these different factors, right? I mean, I feel like the exercise for central bankers, and perhaps it's always been this way, but at least in the past couple of years, is like, well, we sort of know where we are right now. We're not really sure where we're going to be 2 months, 3 months, a year from now.
And I think that will be, very reflected at the Bank of Canada meeting on Wednesday. So, what you're left with is, a backward-looking message that speaks to, an economy that's been softer than expected. Inflation pressures are dissipating. Some of that labor market strength is coming off, but you've got new risks on the horizon. So, the Bank of Canada is going to have to acknowledge some of that recent weakness. While, perhaps without leaning into what it would mean for policy in an environment where energy prices hadn't spiked. So, the Bank of Canada has said that it remains very difficult to predict the timing and the direction of the next move in interest rates. While the market seems to have much higher conviction that the next move will be a hike, and potentially as soon as Q3 or Q4 of this year, we think the Bank of Canada is going to aim for more of a balanced message by keeping that discussion of rate cuts on the table. There's just very little incentive for the bank to lean into a more hawkish message at this meeting, given the recent weakness we've seen in the domestic economy, given the fluidity of the situation in the Middle East, and just how quickly markets can move on them here. We think they'll try to keep all options open going forward.
All options. I think a lot of people, when they hear the fact that the jobs number was so weak, they're a little bit worried about the Canadian economy. When they hear the market pricing in a hike at some point later this year, you think that's more of a next year story. And the natural question for some people might be, well, what about a cut if the jobs market is not doing so well?
Well, it's certainly possible. Before energy prices had spiked, we had been arguing that risks were skewed towards easing over the near term, over the next 6 months, say. But that was largely tied to trade uncertainty, the prospects for USMCA renewal. If that process goes smoothly and we do start to see growth pick up over the middle of this year and the beginning of this year, that should keep the bank on a trajectory to hike rates over the early 2027. I think with more signs of weakness in the rearview mirror, the Bank of Canada needs to keep that option to ease rates in their quiver, if you will. It may be a lot more challenging to cut rates if inflation is heading towards 3%, because oil prices are trending near $100. But if we do see the economy move closer to a hard landing, if growth doesn't respond to the rate cuts from last year and the expansionary fiscal policy from the federal government, that path is still there. It's just, there's a much higher bar to ease rates in this type of inflation backdrop. So we think the domestic outlook would need to, remain quite muted for that to materialize.